This is still lecture 1 for week 11, but this is part 2 lecture. I hope I can finish all the lecture as soon as possible. Now you are doing topic 7, so I hope I can finish all the lecture as soon as possible. And then if we have time left, let's say in week 13 or week 14, then we can do sample question, past year exam question, etc. So that is the thing that I'm trying to do. Okay, topic 7 is about performance evaluation system. I have explained in the previous lecture that there are 3 types of performance evaluation system to be covered in this topic. The first one is ROI, and then the second one is RI or residual income, and the third one is EVA, value added something, economic value added method. Okay, see the residual income. In contrast to ROI, which is a percentage, residual income is a dollar amount. So I'm very sure that you have seen how to calculate residual income when you did ACT4132. So just this one is just like to refresh your memory. Residual income method is a dollar amount. Okay, so see the equation here. Residual income equal to investment center income less an imputed charge for the investment in the unit. You will see in the next slide there is a sample calculation for RI. RI is equal to the desired minimum rate of return times the level of investment in the unit. RI or residual income can be interpreted as the income earned after the unit has paid a charge for the funds invested in the unit. To calculate the RI, you have to have a rate of return. The rate of return is like a interest rate. It is in terms of percentage. Okay, let's see. Okay, this is the way to calculate the RI. To calculate the RI, you have see this blue box. First, you have to have the amount of the investment. In this example, the amount of investment is $192,500, and then you have to have a minimum rate of return. The minimum rate of return is set by a business. Let's say you have to calculate the RI for business A, then the RI, the rate of return is set by the business, decided by the management of the business or the company. The management has to decide whether this project, what is the minimum rate of return. This project, what is the minimum rate of return? Or the management has one minimum rate of return for the whole business. So it depends. Okay, so but in the if in the examination, the question will give you the minimum rate of return. Most of the time, the minimum rate of return is according to the risk of the investment. The higher the risk of the investment, the higher the required rate of return. So see here, investment times the minimum rate of return 12% equal to 23,100. That is the minimum income for this investment. So after that, you compare with the actual income from the investment. In this example, the actual income from the investment is $26,000. So now you can see that the actual income is higher than the minimum income required for the investment. So residual income in this situation is $2,900. When the residual income is positive, we can say yes to this investment. If the residual income is negative, then we say no to this proposed investment. Okay, now this is in this box here, you can see comparison for calculation of return on investment and residual income. So you can see the ROI, Midwest ROI 13.51%, Boston area ROI is 18.16%, South Florida ROI is 12.67%. That is one system that can be used to measure performance. See, ROI. RI is another method that can be used to calculate or measure the performance. So in this calculation, the RI is the minimum rate of return is 12%. So you see here, Midwest, the return is 23,100. The RI, the residual income, is 2,900. Boston area, the RI or residual income is $13,060. South Florida, the RI is $890. If you rank this 1, 2, 3 business segment or investment according to RI and ROI, you will see the rank is same. See, the highest, the number one rank is the Boston area. The ROI is 18.16%. The RI is $13,060. $60. So that is rank number one according to RI or ROI. The second in the ranking is Midwest. Midwest is ROI 13.51%. The RI is 2,900. South Florida rank number 3. 12% ROI and $890 RI. It is not always happen like this. This is like a coincidence. You see the ROI, the result of ROI is consistent with RI, but in many situation, in real situation or in other fictitious situation, most of the time when you calculate ROI and RI, the rank are different, so you have to aware about that. So you have to think, you have to decide which method is appropriate for one situation. Okay, see here the explanation here. In this case, but not always, the RI calculation for CompuCity produces the same relative profitability ranking as the ROI calculation. Like I said earlier, in this example, the ranking is same, but in other situation, most of the time the ranking are different when you use ROI and when you use RI. Okay, this RI is not very difficult to calculate, and the higher the RI, the better the investment. So these are list of advantages and limitations of RI. See the advantages first. The first one is support incentive to accept all project with ROI higher than minimum rate of return. So this is the main thing about the RI. When you learn about ROI, you have seen that one of the disadvantage of ROI is it may encourage managers to accept new investment, but RI has no such
disadvantage. And most of the time, RI, if the project can generate, if a project or investment can generate return of higher than the minimum rate of return, then RI will suggest that the business accept the investment or project. It is not like the ROI. ROI is different. It has some limitation. It may encourage businesses not to accept new investment. And number 2, can use the minimum rate of return to adjust for differences in risk. This one is another advantage of RI. You can adjust the minimum rate of return. For this kind of project, the rate of return is like this. For riskier project, the rate of return is higher. So it can be adjusted. The minimum rate of return can be adjusted. Number 3, can use a different minimum rate of return for different type of asset or investment. So if you have a business, or if there is a business, then for this kind of asset, the business can set this minimum rate of return. For properties, this is the minimum rate of return. For what else? For equipments, this is the minimum rate of return. Okay, so for investment in intangible asset, okay, this is the minimum rate of return. So you can adjust the minimum rate of return according to the type of the assets. But residual income also has several limitations. The first one is favor large units when the minimum rate of return is low. So residual income is the absolute number. It is not like a ratio. So if the business unit is a big business unit, most of the time the amount of the return or net income can be generated from an investment is big. So it favors large units, investment by in large units or by large units or segments. So if a unit or segment is a small unit or segment, then most of the time the total number of the return or net income that can be generated from an investment is small. So if you use ROI, the number of the ROI, the percentage of the ROI is scaled by the amount of investment. So whether the unit that proposed the investment is big or small, the number is will be adjusted because it is in terms of percentage scaled by the amount of the investment or asset. But RI is not. It is an absolute number, 20,000, 30,000, 40,000. So the bigger the business unit, the more the probability that the investment is accepted or is accepted or what? It's accepted. Okay, number 2, not as intuitive as ROI. Like I said earlier, when you calculate ROI, you calculate in terms of percentage. It is like a ratio. The return on investment. So profit divided by the amount of the investment. But RI is not like that. It is like plus or minus only. RI is the amount in excess of the minimum rate of return. There is no ratio related to it. Number 3, may be difficult to obtain a minimum rate of return at the subunit level. So you can see that
if a business uses RI, they can adjust the minimum rate of return. It is easy to say, but when you have your own business or you are a manager in a big business, so it is not easy to obtain a minimum rate of return for different segment of the business or different type of investment. It is not easy. You have to evaluate the characteristic of the segment or investment, and then you have to compare with other investments. So it is not a straightforward process. It is maybe a complex process, but both ROI and RI has several advantages. The first one is congruent with top management goals for return on assets. Every top management want return on assets. So both methods are also focusing on the return on asset. Comprehensive financial measure includes all the elements important to top management: revenues, costs, and level of investment. If you use both ROI and RI, then if you use both ROI and RI methods to evaluate performance or to evaluate investment, then you can say that you have used a comprehensive financial measure, because when you use the methods, you have considered the revenues, costs, and level of investment. Comparability expense. Number 3, comparability expense top management span of control by allowing comparison across single business units. So the thing is, this is the third advantage of both ROI and RI. If a business uses ROI and RI, then it allows comparison across the single business unit.
But this method also has several limitations. May mislead strategic decision making, not as comprehensive as the balanced scorecard, which includes customer satisfaction, internal processes, and learning, as well as financial measures. The balanced scorecard is explicitly linked to strategy. So ROI and RI are good. You have seen several advantages of these two methods, but one of the things about these two methods is it may mislead strategic decision making. They are good, these two methods are good, but not as comprehensive as the balanced scorecard. If you can remember balanced scorecard has 4 components, 4 aspects considered in the balanced scorecard performance evaluation system, which is the customer satisfaction, internal process, learning, and the financial measures. So balanced scorecard is more comprehensive compared to ROI and RI. The second limitation here is accounting issues. Variation exists in the definition of measurement of investment and the determination of the profit. Like I said earlier, when you learn financial accounting, you know you can calculate the value of an investment using different methods. So you will get different number. And also when you calculate your profit, there are many things that can make the profit increase or decrease, high or low. You can choose this depreciation method or inventory evaluation method. Then these methods can affect the amount of profit. So when you use RI and ROI, always remember that the numbers can be affected by the methods used in the calculation of investment and cost. Okay, short-term focused investment with long-term benefit may be neglected. Most financially based methods are short-term methods. So RI and ROI are methods that focuses on the financial aspect of the investment. So most of the time these kind of methods are short-term based method and does not consider the long-term benefit of the investment. Okay, this is the method number 3. This is new, I think. This is a new method. Economic value added method is a business unit income after tax and after deduction of cost of capital. The short form is the EVA, Economic Value Added Method. EVA is a registered trademark of Stern, Stewart and Company. EVA approximates an entity's economic profit. EVA involves numerous adjustments to reported accounting income and level of investment. Stern Stewart reports up to 160 such adjustments. So this is like complex method. Similar to residual income, EVA motivates managers to increase investment as long as the expected return in dollar term above the cost of capital is positive. So this method has some similarity with residual income method. Okay, how to calculate the EVA? EVA equal to NOPAT minus K times average invested capital. Okay, NOPAT is equal to after tax cash operating income after depreciation, after tax operating income after depreciation. That is the total pool of cash funds available to suppliers of capital. And then equal to revenue minus cash operating costs minus depreciation minus cash taxes on operating income. So I think the NOPAT is not net operating profit after tax. If we want to find this NOPAT in the financial statement, then it is non-operating profit after tax. K in the formula is the minimum rate of return or hurdle rate. For example, the weighted average cost of capital, something. And then times average invested capital. Thus, EVA equal to RA times capital, where R equal to NOPAT divided by invested capital or cash on cash return. I think I will show you a sample question related to EVA. Then you can see how to use EVA and then how to interpret the results of the EVA calculation. Okay, the next thing is to estimate EVA. It is necessary to adjust reported accounting numbers, both earning and level of investment. The latter are referred to as equity equivalent adjustment or EE for shorts. So in the white box here in this slide, you can see some common EVA adjustment. The first in the left side, there are adjustments to capital, deferred income tax expense reserve, LIFO reserve, R&D expenses, bad debt reserves. And then in the right side of the box, adjustment to NOPAT. First one is change in the deferred tax reserve, change in LIFO reserve, change in bad debt reserve, and unusual gain or loss. So like I said earlier, hopefully in the next lecture, I will share with you a sample question related to EVA. Then I hope you can follow the idea. Thank you very much. That is the end of lecture for topic 7, and this is the end of lecture 4, lecture 1 week 11 part 1, sorry, part 2. This is part 2. Thank you very much. Do not forget to write your name and metric number in the comment section. That is your lecture attendance.